Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. Picture the deal you almost pulled the trigger on. 3 months of research behind it. A single-family rental in Orlando, listed around $387,000, rents for about $2,000 a month. You'd already done the real work. The job base checked out, the population trend checked out, the rent history checked out. You were maybe 2 days from writing the offer. And then the headlines hit. Orlando home prices are falling. Sunbelt correction deepens. Your whole feed turns red. And the offer you were about to sign, the one you spent a quarter of a year getting comfortable with, suddenly feels like reaching out to catch a falling knife. So your cursor drifts over to the word withdraw. Be honest, that's exactly where most people click. So before you click, you check the number, and the number backs the headline on one axis. That same house a year ago was worth about $398,000. Today, $387,000, down almost 3%. $11,000 of value gone in 12 months. The Chiron was right. Most people stop reading right there. They pull the offer and they feel smart for dodging a falling market. Do not stop reading there, because you just read one number and a rental has two. Here's the second one, the one the headline never prints next to the first. The rent. Same metro, same 12 months. It didn't fall. It went up about 0.7%. Sit with that, because it's the whole episode. The price dropped, the income held. Those are two different axes, your basis and your rent. And the market only reported one of them, the one that scares you, not the one that pays you. And this is not an Orlando fluke. Pull back and look at the whole map. A metro-level home value index has a big slice of Sunbelt metros down on price this year. Austin, Tampa, Naples, Denver, the whole correcting belt. But an asking rent index? Only a tiny fraction of metros are down on rent. Prices are correcting all over the place. Rents mostly aren't. That gap is the entire story of this housing market, and it's hiding in plain sight, because everybody's staring at the price line and nobody's reading the rent line right underneath it. So run the two together on that one house. The price-to-rent ratio just moved from about 16.7 to 16.1, and lower is cheaper for a buyer. Run it as a cap rate, and the yield went from roughly 3.0 to 3.1%. The market crashed, and your yield went up. Same house, same tenant demand, $11,000 cheaper, $14 a month more rent. So here's your decision. 3 options. Hit pause, pick the one you'd actually take, then come back. Option A, make the offer. The headline is a price statement. Your yield lives in the ratio, and the ratio just moved your way. You're buying the same income for $11,000 less than last year on a metro you already underwrote. Option B, wait for the bottom. Prices are still sliding, so hold off until they stop. Why buy today if the same house might be cheaper next quarter? Option C, cross Orlando off. A falling market is a falling market. Redeploy to a metro that's actually going up. All right, it's option A. But the reason is the whole lesson, and it's the exact opposite of what your feed is screaming. Prices are falling is a true sentence about one number. It tells you nothing about the number that actually pays you. A rental is an income instrument wearing a price tag. And this year, the price tag came down while the income held. The correction hit the axis that helps a buyer, your basis, and it spared the one that pays you, your rent. You didn't reach for a falling knife. You caught a sale on an income stream that's still fully intact. Now the honest part, because it's the whole discipline, and I'm not going to sell you a fairy tale. This is not a cash flow deal. At a 3% cap, that house, 20% down, a 6.69% mortgage, still costs you close to $1,000 a month out of your own pocket on day one. And at that cap, your principal paydown doesn't close the gap either. So this deal does not carry itself. And it is not a bet that the price bounces back next year. What the correction actually handed you is a better basis on income you already wanted, the same house, the same rent, $11,000 cheaper than a year ago. That discount is your margin of safety. It's the part you control. A price forecast isn't. So option A is right for a specific, narrow investor, the one who already decided Orlando fits, who did the 3 months of homework before the headline showed up, who's underwriting the Metro's fundamentals and not a rebound, and who can carry that negative cash flow while the rent holds. If that's not your strategy, that's a strategy conversation, and it's a fair one, but it is not a headline conversation. And if the only thing turning this into a buy is a hunch that the price recovers, that's awaiting appreciation you don't control, and it's not your deal. Don't let a Chiron reverse a portfolio decision you make on the fundamentals. And here's the part about the rate, because I know it's sitting in the back of your mind. The 30-year hit the top of its 12-month range in early August. And underneath that number is the one almost nobody watches. The gap between the 10-year Treasury and the rate you actually get has been parked near 2 full points all year, as wide as 2.4, as narrow as 1.8. That gap is the Powell spread, and the lesson inside it is simple. The rate is not sitting around waiting for you to feel ready. You underwrite the rate you have today. If it comes down later, you refinance to cut the carry, and you keep the correction era basis you locked in. A cut is a bonus on a decision you already made. It is never the reason you make it. Why not B? Wait for the bottom. Because the bottom is a spot you can only find in the rear view, and nobody pays you a dime for spotting it late. While you sit on your hands, the thing that actually matters, the rent, is holding. Waiting doesn't protect your income. It trades a known, improved basis today for an unknowable one later, and it quietly hands your held income to whoever writes the offer first. And in a correcting market, days on market stretch. That is real negotiating leverage today, and it evaporates the second sentiment turns. Why not C? Cross it off. Now, C is the right call for one investor, the cash flow buyer whose thesis needs income on day one. For them, redeploying to a cheaper cash flowing Metro is exactly right. It is the move we made in this week's $80,000 allocation episode. What makes C the headline mistake is picking it because the price fell, not because your strategy changed. Reading a falling price as a falling market is the error. The market that should actually scare a landlord is the one where the rent is rolling over, tenants leaving, concessions climbing, income eroding month after month. That is not this Metro. Cross Orlando off and you're not dodging risk. You're dodging the one axis that's on your side, because a television told you to. So here's your challenge today. Take the Metro you've been researching, the one the headlines have you second-guessing right now. Pull 2 numbers, not one. What price did over the last 12 months, and what rent did? Put them in the calculator at reiprime.com at today's rate, and read the ratio between them. If the price fell and the rent held, your yield didn't crash, it widened, and the discount is real. If the rent is rolling over too, then believe the headline and walk. Either way, you'll have decided on the Metro's own 2 numbers, not the country's average, not a Chiron. Because that national number everybody's reacting to, it's the mean of 2 markets moving opposite ways, and only one of them is the market you're actually buying into. I'm Martin Maxwell. This has been the 5 Minute Prime Podcast. I'll see you next episode.